The Court of Appeal says the charges of or what you call charging stamp duties on what you call payments into your deposits and online transactions, what you call electronic fund transfers, does not qualify for stamp duties. The Court of Appeal overturned the earlier decision of the Federal High Court, saying that the decision of the banks and the central bank were correct. Now the Court of Appeal says no, stamp duties are not applicable on bank teller deposits as well as electronic fund transfers. That's one story. Stick it into the market street overnight. But there's a bigger story coming through between today and tomorrow. We expect the Central Bank of Nigeria to release the latest financial system stability report. Dr. Hassan Mahmood is a group head in charge of surveillance at the Central Bank of Nigeria and is joining us this morning for this discussion. Dr. Mahmood, thank you very much for coming through on this conversation. We appreciate your time. As the head of a macro-prudential surveillance at the Central Bank, these reports do come often. So what is in the current one?
Thank you very much for having me, and good morning. Yeah, the current report is a 2018 edition of the Financial Stability Report, and it provides a kind of macroeconomic surveillance of the development in both the domestic and the global market and how that impacts on the financial system, particularly the banking institution or the banking industry. We've seen several challenges that are mixed and that are impacted on the financial system. At the global scene, you've seen output growth declining, which means aggregate demand at the international level is going to decline. We've seen pressure on interest rate, particularly in the United States, as normalization creeps in. We see that too in the Eurozone area. We've seen inflation picking up in most advanced economies. And down to the domestic scene here, we're seeing inflationary pressure still persisting, even though inflation is going down gradually. We see pressure at the forex market with the developments at the global scene that I just mentioned about, impacting significantly on capital flow reversals, which will impact on our FX market. We see other domestic indicators, including unemployment, including credit to the economy, particularly the private sector. And those are what fits into the performance of the financial institution or the banking sector. Invariably, the financial soundness indicators, which are measures we use to appraise the performance of the financial institutions, look somehow relatively robust, meaning there are kind of resistance or resilience to these macroeconomic uncertainties or imbalances that we are witnessing in the economy. But as we go on, I will give you a further breakdown of the performance of the industry.
So do you think this latest report well contextualizes what the World Bank and the IMF has been talking about the state of the global financial system? The report out yesterday out of Washington says the global market is a little bit topsy-turvy, as it were. Says the U.S. stock market is overvalued. There are concerns over debt servicing in a number of countries, in particular emerging markets and all of that. Do you think this report well contextualizes some of the concerns and the positives, as it were, for the Nigerian banking and financial system within the broader global space?
Indeed, it does. Yeah, the key challenges we get from those global developments are, one, that the demand for commodities, particularly the oil that we export, is going to be challenged, and that will reflect in the prices of oil. Also, because rates are going up in those economies, then we are likely to have a capital flow reversals, which will impact on people that have investment in Nigeria now trying to pull out to go to better havens or more higher return havens, and that will put demand pressure on our FX market. Indeed, we've had stability in the FX market, but when these demand pressures persist, then you start seeing central bank interventions to moderate the rate, because we don't want a situation where depreciations will come in, because there's a strong pass-through from the exchange rate to the inflation rate. And because we are curtailing inflation rates now, given that we are still maintaining our concessionary tight monetary policy stance, to have a real positive interest rate to attract these foreign capital inflows. In terms of the debt buildup, that is also a concern. and we've seen the policy of where we are shifting from borrowing domestically at high interest rate to substituting that with foreign borrowing, which has lower rates. However, we need to manage the FX side of it so that when the payback time comes, we don't have that pressure of depreciation coming into the FX market.
Yeah, your report is coming out after the IMF staff meeting conclusion, which was a report released just about a week ago. Part of what was said in that report about the visit to Nigeria between the last week of September and the first week of October was that prudential guidelines, prudential issues for banks in Nigeria are in place and are looking much better. But again, there are still concerns about non-performing loans and a lot of other things in the Nigerian banking space, including the extension of credit, which has been a recent monetary policy focus of the central bank. How will this report encapsulate the recent development that we've seen from the financial regulator in terms of extension of credit, and why does credit need to be watched very carefully by deposit money banks and not the existing non-performing loan scenario within the banking space?
Yeah, like I said earlier, the financial soundness indicators look relatively robust if you compare it to what the economic uncertainties are showing. Indeed, the NPL, the non-performing loan ratio, is going down gradually. We're still in around the 11% threshold compared to the 5% that we're supposed to be doing. However, some of the significantly imported banks are doing far less than that number. And the capital adequacy ratio for the industry, which covers the capital buffer for their total exposure, is way above 20% for some of the very large banks, and the industry average is well above 15%. The threshold we do is 10% for the industry. So if you look at those parameters, you see that the level of resilience is quite good. There are indicators of challenges that may impact on this. The sustainability of it depends on how things play out in the short to the near term. However, from the IMF report, we've also seen issues that are related to the debt portfolio that we're holding, particularly the debt servicing portion of it, and how government financing of that deficit is, or the central bank financing of that deficit is an issue. But however, we have a buffer to cover for that because, the TSA has huge trillions of naira in that. So sometimes some of those balances are overdraft balances, and when the accounts are balanced, you see that the deficit portion that is really financed from the central bank is significantly reduced. However, it's also important to state that borrowing is not the issue, it's what you use the borrowing for and how that borrowing is going to impact on the domestic economy. If these investments are properly deployed for the infrastructure and whatever, and then you see aggregate demand building up, then you see industries springing up, and then the manufacturing output growth will increase. If that's upon employment comes in, inventories are declined, and output GDP growth rate improves significantly. With that, you start seeing the payback will not be an issue significantly, and then the NPL ratio will also start to be going down.
You're in charge of macro-prudential surveillance at the central bank, which means that you're looking at the monetary policy, that you're looking at the environment, and you're looking also at the fiscal policy environment. So it's a very tough job for you, Dr. Hassan Mahmood, in terms of what you do and check in with on a daily basis. So if you look at 2019 year to date, what's your take on the fiscal macro area and the banking and the financial system? If you look at the budget, if you look at the rapid fireworks from the central bank itself in terms of monetary policy, then we have an election, then of course we had a new cabinet and what have you, we're doing more borrowings. Put all of this together in terms of what you're looking at through the field glasses.
I think for those developments, I think the financial system, particularly the banking sector, has done fairly well, including even the economy has done fairly well in withstanding those shocks. Last year we had the elections. There were fears of uncertainties that there will be huge capital flow reversals, investors are going to pull out of the economy, security challenges, and that we were worried that do we have enough cover to cover those pullout. But we saw that actually towards the end of last year, capital inflow actually increased. In terms of the rigidities we find in the supply chain, particularly to boost domestic output, central bank is doing a lot to motivate that real sector of the economy in order to, make credit available to the SMEs, to the household firms, such that, output growth will increase significantly in the economy, and that will translate to, employment growth and poverty reduction and financial inclusion and all that chain of events that are likely to take place. Yes, indeed, there are new challenges coming up in 2019, the trade tensions, the United States, the China, the slow growth even in China, the developments in advanced economies, the normalizations going on both in the Euro area and in the United States are all challenges that are still persisting, and that the Nigerian economy should also be, proactive in taking adequate buffers and covers in-house to be able to, be resilient to this kind of shocks. And one basic way to address that is to look inwards. Create the demand domestically, create the output domestically, such that your vulnerability to external shocks are significantly limited. And the diversification of the fiscal authority now is the right way to go. We've seen significant addition to the GDP coming from the non-oil sector, particularly the agriculture and the services sector. So these are internal developments, and that will shield us from those external shocks, and that will also make us a bit robust to withstand some of these uncertainties coming on board.
Dr. Hassan Mahmood, thank you so much, the group head in charge of macro-prudential surveillance at the Central Bank of Nigeria. Thank you very much for this exclusive curtain raiser on the new Financial System Stability Report, which you expect the Central Bank to release in the next couple of days. Thank you so much for coming through on the show.
Thank you very much for having me.